Welcome back. So in this video, we're going to think about why Piketty argues that the disruptions of the early 20th century, essentially World War I and World War II, led to this period of relatively low inequality and relatively high labor shares in the economy. And then we'll spend a little bit of time talking about why wealth and why a high return to wealth should lead to higher inequality overall. So Piketty's fundamental argument is that what happened in the world wars and the Great Depression is the destruction of a large share of Europe's capital. So as you can see here, Piketty's data suggests that prior to World War I, the total share of capital, the amount of capital as a share of GDP, was about 700%, or 7-to-1 in the United Kingdom. In other words, for every dollar's worth of output produced in a given year, there were about $7 worth of capital, if you count the value of land, the value of machinery, housing, all sorts of other things that are included in capital. However, after World War I, this stock of capital fell precipitously down to only about 200% of GDP. So as a result, there's much, much less capital in the economy. And over the rest of the 20th century, capital as a share of GDP has been rebounding towards that original 7-to-1 level. Now, why should this lead to a larger capital share in the economy? If we had an economy that was well described by the Cobb-Douglas production function, it wouldn't. What we would expect is that in this early period, right, where you have a very high capital to output ratio, you would have really low interest rates on capital, so those $7 of capital for every dollar of output wouldn't earn a tremendously large amount of rent. Whereas in this later period, when you have relatively little capital, each dollar of capital would earn more rent. But if instead capital and labor are gross substitutes, which is to say that as you increase the amount of capital, you decrease the rental rate by less than the percent increase in the amount of capital, then we would expect this destruction of capital to lead to a reduction in the total share of economic output consumed by capital. And indeed, if we go back to this graph that shows you the capital versus labor share of income, in Britain this time rather than in France, you can see that at the same time that you have this large destruction in capital, you see a big increase in the labor share of economic output and a decrease in the capital share of economic output. So Piketty takes this as suggestive evidence that rather than being Cobb-Douglas or gross complements, labor and capital might be gross substitutes. He also supports this argument by looking at the rate of return to capital. So again, remember, what we should expect to see if capital and labor are related to each other with a Cobb-Douglas production function is that the rate of return to capital will increase when capital is destroyed by World War II. And indeed, we do see this. But this observed rate of return increase, right, from about 5% to about 11% is a lot less than the destruction of capital, right? We went from about a 7-to-1 ratio to about a 2-to-1 ratio. So we should have seen a more than tripling of the rate of return to capital. So again, this is going to be taken as evidence that capital and labor are gross substitutes rather than gross complements or Cobb-Douglas. Now, it's not just the UK. He's going to see the same pattern, right, the same 7-to-1 ratio of capital to labor in France, followed by the same recovery after the destruction of the World War, with the same change in capital to labor ratio and a similar pattern of rate of return to capital, where the rate of return does increase after this capital destruction, but not by nearly as much as you would expect if the economy was Cobb-Douglas. Meanwhile, he says that this basic prediction, this basic understanding of inequality as being driven by the total stock of capital is also supported by looking at the United States. So prior to the 20th century, in the 19th century, the US had relatively low inequality compared to Europe. And it also had relatively low stocks of capital relative to output, which he argues can be expected when you're talking about a relatively new country that hasn't had time to build large inherited fortunes. So if we look at the share of, basically the capital share of GDP in the United States, we see that it's about 3-to-1 at the founding of the country, was steadily increasing up to about 5-to-1 at the point that the Great Depression started, and then fell after World War II. And he argues that there's also much less destruction of capital in the United States relative to Europe from the world wars, because we really weren't involved in World War I until the very end. And whereas we expended tons and tons of resources in fighting the world wars, they weren't fought in the United States or on US soil. So there was just much, much less destruction in the United States than there was in Europe. Okay, so to sum all of this up, right, we're going to see that across Europe, you see a stable capital labor ratio of about 7-to-1 prior to World War I, this rapid destruction of capital followed by a recovery. Piketty argues that a fundamental force driving towards very, very high rates of capital to GDP ratios is that the interest rate earned by capital, or R, tends to be higher than the economic growth rate, or G. The reason that that might lead to increasing levels of capital accumulation relative to output is that if a family has a very, very large fortune, their fortune is going to grow relative to GDP as long as they don't spend too much of it. In other words, if you've got an interest rate of about 5%, as has been typical throughout much of history, and a GDP growth rate of 1%, which is relatively high compared certainly to most of human history, but is also about the level we see now, a family could potentially spend 2 to 3% of their wealth every year and end up with their total stock of wealth increasing relative to GDP anyway. In other words, when you have R greater than G, it's possible for very wealthy families to live off of the rents from their capital without cutting into the stock of capital overall or having their capital stock diminish as a share of the total economy. Now, the reason this might not drive all the way to the robot apocalypse, as Marx predicted, is that if we want to think about the stable or long-run level of capital to output, we of course need a more complex model than just R greater than G. We need to think about the way that increased capital shares are going to decrease the interest rate, and we're going to also want to think about people's individual motivations for consumption versus savings. So if very wealthy people consume a sufficiently large share of their fortune, you won't end up with large accumulations of capital, even if you've got interest rates that are fairly high relative to the growth rate. But R greater than G makes this possible and makes it likely under various assumptions about people's motivations for saving. Now, another force that's going to lead towards accumulation of capital, and in particular towards concentration of capital, is that Piketty argues that those with very, very large shares of capital, very, very large asset pools, can end up earning larger returns on their money than do people with relatively fewer assets. And the idea here is a combination of factors. The first is that if you've got a sufficiently large pool of assets, you're going to be much more tolerant of risk than those with a smaller pool of assets. The reason for this being, if you're living off of a very small fraction of your total wealth, you can survive a few bad years of economic growth or of return on your capital without really affecting your lifestyle very much. Whereas if you only have a little bit of capital, fluctuations in your returns will have a big effect on you. In addition, Piketty argues, and I should say that this goes against the grain of a lot of economic thought on this, that those with very, very large shares of capital can also have access to better capital managers or more sophisticated investment strategies. And he makes this argument by showing that if we look at universities, we're going to see that the universities with the largest endowments, like Harvard, Yale, and Princeton, have earned historically a higher rate of return on their money than have universities with smaller endowments. Now, I should note this is a finding that's in a certain amount of dispute, and in particular, there's a decent amount of evidence that Harvard, Yale, and Princeton took a pretty big bath in the Great Recession, so this might not be true overall. But Piketty makes this argument that if this is true, it's going to lead to a higher growth in wealth among those who are already wealthy than among those who are poor. The overall effect of all this is that we might expect the natural or stable level of wealth distribution to be very unequal. Piketty shows that in all the countries that he looks at, there was a very, very high inequality in wealth prior to World War II, right? We can see that the top 10% of wealth holders in France held upwards of 80% of wealth, and this was only increasing over time prior to World War II, whereas the top 1% of wealth holders held 60% of all of France's wealth prior to World War I. And again, with an upward trajectory. So this is a reasonable amount of confirmation of some of Marx's hypotheses, right? What we're seeing is that if we look at economic history prior to the disruptions of World War I, what we saw was ever increasing concentrations of wealth and wealth taking a large, if not necessarily growing, share of total GDP. And if we look at other countries, if we look at Sweden, if we look at Europe as a whole and the United States as a whole, we're going to see this same tendency. In every country he looks at, you saw increasing concentration of wealth prior to these disruptions that start in 1910. Okay, so just to sum up where we've gone, right? If we think about what Piketty's work argues is essentially that if we look at economic history prior to World War I, we would conclude that the tendency of market capitalism appeared to be for very, very large accumulations of wealth to become standard, right? Equilibrium levels of wealth relative to output to be very high, a large share of economic output going to the holders of wealth, and wealth to become increasingly concentrated, very, very highly concentrated among a handful of very, very rich families. In other words, rather than thinking of this mid-20th century period where inequality in earnings is really fundamental and dominant to our understanding of economic inequality, and where labor takes the lion's share of economic output, we might think that the natural or normal state of capitalism is high inequality dominated by inherited wealth. So the next question Piketty asks is, how does this describe the state of the world now? In other words, if we think that this mid-20th century was a period of recovery towards this normal state of affairs, do these handful of disruptions that we see now, where the labor share of GDP is falling and inequality is rising, match this story? Does it look like we're returning to the world of the 1900s, where wealthy aristocrats controlled a large share of world GDP? So the first question that he asks is, do we see that wealth is becoming increasingly concentrated over time? And the answer to that question is a pretty clear yes. What you can see here is that if we look at the wealth of the world's billionaires over time, we can see that there's been an almost tenfold increase in billionaire wealth from the late 1980s to today, and a similarly large increase in the number of billionaires. If we look instead at the share of wealth controlled by billionaires over time, we're going to see the same thing, that that billionaires have gone from controlling about 10% of the world's wealth in the mid-1980s to controlling almost 40% of the world's wealth today. So in this respect, Piketty argues that the world of the 21st century is beginning to look a little bit more like the world of the 19th century, in that wealth is increasingly concentrated into a small number of hands. Similarly, if we look at the share of wealth being held by the richest 1 in 20 millionth families or 1 in 100 millionth families, so this is an even more rarefied pool of people than billionaires, we're going to see this same pattern of increasing concentration of wealth, from about 0.3% of wealth being in the hand of the basically 20 millionth richest families, to that share going up almost to 1% of the world's wealth. On the other hand, there's some patterns that don't look very 19th century at all. So if we look at this US income inequality and we ask how much of this is a result of wealth concentration, the answer appears to be not very much at all. So these dark lines here, these dark triangles, show you the share of total income going to the top 1% if we include all sources of wealth. And then these hollow triangles underneath show you the share of wealth going to the top 1% if we exclude rents on capital. And so what you can see is that we've seen almost the same amount of income concentration if we don't consider the role of capital as if we do. And the reason for this is essentially that in the 21st century, in contrast to the 19th century, a lot of income inequality is driven by a handful of people earning a tremendous amount of money. And this is primarily about CEOs and other managers earning a tremendous amount of money. And this is a different pattern from the 19th century, where the wealthiest families were generally passive landowners. However, what Piketty argues is that these super earners today are going to pass on their wealth to their children, who will then be inheritors of large fortunes. So even if we have big inequalities today driven by earned income, that's going to result in big inequalities tomorrow being driven by passive income or income from capital.